Hey traders, welcome to my Q1 2023 quarterly conference call. Thank you for joining me here in Cambodia today, out in the jungle near the beach. We're going to run through a variety of topics, pretty much the same content as usual. We're going to go through the state of the market as it is at the moment, the state of the wider market, so the macroeconomic climate, how that affects the portfolio specifically. And finally, I just want to touch on the topic of artificial intelligence, because it's very much in the news at the moment. And I want to give my thoughts on what that means for investments and where there might be opportunities there. Before that, though, I just want to spend a brief moment talking a little bit about myself. For those that are new to me as an investor. So I started out at university in 2009 studying business and management. And that included a lot of accounting and finance and economics based modules. And that then took me on forward into working with Deloitte initially. And from there, I then took a year out traveling. You can see I spent a lot of time in Cambodia before returning to Deloitte Digital, where I largely worked in the financial services industry. My role there was predominantly as a project manager. So helping those clients you can see there, Barclays, Deutsche Bank, HSBC and the like, get the most out of their software and develop new software to meet their goals. After a few years with Deloitte Digital, I went full-time with eToro and traveled around as a digital nomad for a couple of years before once again returning to the UK to London to work for a social enterprise called Give Clarity. They operated in the non-profit space, working with some clients, big and small, as you can see there, the likes of the United Nations Refugee Agency, to the International Rescue Committee, as well as others like Girls Not Brides and the Trussell Trust. Back in 2021, I then decided to go full-time with eToro once more, and I've been full-time with eToro since then. And at the moment, I'm traveling around and find myself in Cambodia. But my full-time profession is researching, analyzing, investing, putting together a portfolio that is hoping to produce alpha returns based on the level of risk that it's operating at. In terms of a little bit about my education and credentials, so you can see there the University of Exeter. I also have a couple of Salesforce certifications, some certifications with the British Computer Society and the Scrum Alliance as well. Their focus is mainly on project management type certifications. More recently, I became certified as a level 4 international wealth manager with the Chartered Institute for Securities and Investments. And finally, you can see there just a couple of small awards: Time Person of the Year 2006 and Nobel Peace Prize winner 2012. So my performance on eToro has varied a little bit, but fundamentally, since joining in 2016, I've made about 900% return on my portfolio. There's been some ups and downs. You can see there that 2017 at the bottom was a very strong year. And then 2018, actually a really good performance based on my investment exposure and risk at the start of that year, followed by a couple of strong years, 2019, 2020. We plateaued 2021, and then 2022 was clearly a bit of a disaster. That figure there, minus 30%, is largely in line with NASDAQ 100. And compared to other more speculative tech stocks, which is where I predominantly operate, not such a bad result, but that's a very difficult sell. To say that minus 30% isn't so bad is obviously a little bit wild. And it's not great. We're still recovering from that. It's going to take a long time to recover from that. And you can see that we're off to a reasonable start in 2023, but that is in balance with lots of other risks, which I'll dive into a little bit later. In terms of the high level stats, at present, I have about 4,300 copiers. My assets under copy is in the range of about $3.2 million, and I have around 112,000 followers. You can see that my annualized return is about 40%. But one thing worth pointing out is this isn't a completely risk-free portfolio. It's more defensive in recent times to counter the volatility that we've seen. But the max drawdown there is close to 40%, which is pretty staggering. And you can see a couple of extra tidbits there as well, such as the standard deviation in terms of the fluctuations month to month, and equally the correlation to the S&P 500. So on to the global economy, where we stand. First of all, I want to focus on GDP and inflation, the two big metrics of the last year. And then I want to dive into how 2022 shaped up before going on to 2023, what I expect in the coming year, followed lastly, of course, by how that affects the portfolio and how we position going into this year. This is quite a stark graph here that I've put together using information from the IMF January 2023 update, which I would highly recommend, by the way. But you can see the inverse relationship we have between inflation and GDP growth. And at the same time, you can also see the almost lagging effect that inflation is expected to have on the global economy. 2021 was a very profitable year for most people. I had a very good year in 2021. But you can see in 2022, that's where inflation really started to peak. And then you can see, particularly in the second half of that year, GDP started to fall. What happened here is central banks changed their monetary policy. They tightened the monetary policy. Inflation rates went up. And as a factor and as a cause of that, a subsequent cause of that, you can see that around the world, economies started to tighten up. Supply chains also disrupted. We had other factors like the war in Ukraine as well, and GDP has then fallen. Going into 2023, we're using IMF forecasts here. We can see that 2023 expected GDP is 2.9%, which should be the bottom in terms of GDP growth, before returning to 3.1% in 2024. That's below the global average of 3.8%. But it is also quite clearly above what we'd consider to be a recession, which is consecutive quarters of negative GDP growth. This varies region to region. I'll come to that in a bit more detail in another slide. But you can also see in correlation with that, in inverse correlation, inflation is starting to fall. At least headline inflation is starting to fall, and that's expected to fall further into 2023 and 2024 as well. Once more, that's very much region dependent. So it depends how each of those regions will be doing. And there's plenty of things that could unsettle those forecasts going into the future as well. So in terms of selected areas, this graph is a little bit busy and a little bit random in terms of the areas that I've selected to highlight. But I wanted to chuck the UK in there just because I'm from the UK and it's quite an interesting anomaly amongst other countries. But the general trend that you can see is that in 2021, there was very strong growth across the board. And then 2022, things really started to subside. So in the US, growth slowed down to 2%. And then across the Euro area, UK, growth was still relatively strong with a strong start to the year, but then also has started to come down. And now the forecast for 2023 is much more dire. So it is largely expected that the US will now avoid a recession, but it is going to be very touch and go. It will be very close. There's some analysts that still predict that might take place. You can see a real contraction in the Euro area as well, driven by many things such as inflation, of course, but the cost of living crisis and the potential escalation of war in Ukraine. And you can see the UK there, minus 0.6% GDP growth predicted for 2023, which is recession territory. And that is one of the few countries that sits within that bracket of actually going negative in terms of GDP growth. 2024, things are also unlikely to recover fast. This isn't going to be a big bounce. We're not going to hit the bottom in 2023 and return to miraculous growth. But one thing that's worth noting is that GDP and the performance of stock markets and equities are not linked necessarily. So, of course, if there's a recession, if the economy slows down, companies are less likely to make profits. But at the same time, the stock market generally acts as a leading indicator. So you'll see movements and reactions in the stock markets before these big macroeconomic trends take effect. There's arguments to say that that's what we're seeing at the start of 2023, like confidence has returned and that we are returning to a bullish period. I think that's a little bit optimistic personally. But towards the tail end of 2023 into 2024, there can definitely be some breakout industries and there's definitely some money to be made. One trend worth highlighting here as well is, of course, emerging markets. So the contraction in terms of GDP growth is largely centralized around advanced economies. The US is, in terms of this portfolio, is very, very important because that's where the majority of the equities are that are in the portfolio. But the US is also a good barometer for the rest of the world in terms of economic performance too. Emerging markets is an interesting area, though. It's one I'm researching more thoroughly at the moment, and I definitely won't shy away from making investments in that space. So what did 2022 look like? Now that we're into 2023, how do we look back on that period? Fundamentally, I think when we look at 2022, is definitely a struggle as an investor, particularly an investor in speculative tech assets. I had to take a lot of defensive positions. I had to add hedges. I had to close positions. I had to diversify more broadly than I would like. But that was all because of big macro factors. And the big one, the biggest influential factor, was the fight against inflation. So as inflation spiked due to a combination of things, due to fiscal stimulus, due to the war in Ukraine, due to supply chain issues, and a large part due to corporate greed as well, what we saw was central banks raise interest rates, and the raising of interest rates is bad for speculative growth stocks because their valuations are largely dependent on future earnings and the discount rate that is then applied to those future earnings. Of course, that wasn't the only factor at play here. 2021 was a very strong year for lots of different reasons. So naturally, of course, there's a reaction to that. And we saw at the start of last year, Russia's invasion of Ukraine, that had a big impact on the stock market, particularly on commodity supply chains. We saw the likes of fertilizer, oil, very key resources for lots of places being put under immense strain, and the sanctions the US placed also furthered that. So that disrupted a lot of what was established as a generally consistent market. And the threat there, the volatility in that region still remains as a big fear for lots of investors. Another big factor at play here was the lockdown of China. So China is a massive player in the global markets. Their relationship with the US is much documented, and that is quite tense at the moment, unfortunately. But China having a zero COVID policy meant that the country was not operating on full steam. It meant that tourism was severely limited. It meant the supply chains were disrupted. It meant that purchasing managers' sentiment was down. And that really took a drain on the economy. We also saw other factors at play tied into that, such as the real estate market, high youth unemployment. But fundamentally, the policies that China implemented in 2022 weren't helpful to global growth. Hopefully, we'll see a reverse of that come this year. Despite these things, it is worth pointing out that in Q4 of 2022, so the last quarter of last year, growth was more resilient than forecast by the likes of the IMF, so it did hold true. And we've seen very strong labour markets still, which is a bit of a surprise. And equally as well, wage growth, despite real wages in most places declining, wage growth has actually been at a relatively acceptable level, which has maintained consumer demand, which has meant that many companies have continued to turn reasonable revenues as well. I think those things might catch up with us a little bit in the next year or so, but we'll just have to see how that plays out. As I mentioned previously, headline inflation has generally peaked. We start to see it come down in many areas, but core inflation, that which excludes energy and food prices, is still yet to get there. It does look like it started to plateau though, so we can hope that that's going to come down in the relatively short term as well. Throughout the year, as I'm sure you may have noticed, whenever inflation data was released, particularly in the US, we saw that markets and equity prices, well, bond prices as well, to be honest, were very sensitive to that data. So high inflation, the natural reaction to that you would expect is that central banks increase interest rates. And as I explained earlier, that has a very real effect on the stock price of many companies. What we have seen as well, and one thing worth noting is that generally central banks have raised interest rates to a higher level than what was forecast. They might come down a bit quicker too, but where we've said that growth next year is maybe 0.2% more than forecast, we might also see a slight reduction in terms of the forecast for 2024 because of the monetary policy tightening that's had to take place and the intensity of that monetary policy tightening as well. So when we look to 2023 and beyond, as we saw in the earlier graph, GDP growth is expected to be 2.9% globally. And that's down in terms of how we compared to this year. But as I mentioned, 0.2% higher than what we thought. So things are looking a bit more positive than what we predicted, say, 3 months ago. But once again, I return to the same point. There's lots of risks here, and it is very, very much dependent on location. So when we look at Europe, there are places that still have inflation around the 10% mark, and there's some indicators there. There's some statistics, there's some metrics that aren't overly favorable at the moment still. So we think about sentiment and confidence. In Europe particularly, those factors have worsened based on surveys. In the US, things are looking a bit more positive, and in China, inflation hasn't had as much of an impact on the economy there either. So there's plenty to be positive about, but we remain sort of optimistically cautious. One thing I mentioned as well was that China's zero COVID policy should be reversed in 2023, and that reopening of the Chinese economy, Chinese tourism, Chinese trade should hopefully reinvigorate global growth and give us a return to some normality. One thing that could be a potential issue there is the US-China trade relations and relations in general. They are a little bit wobbly at the moment with all sorts of tomfoolery going on, such as the balloons flying over the US and the cancelled Blinken visit to China. And of course, big issues over Taiwan and the sovereignty of Taiwan. One thing to note is that monetary policy is, of course, tightened across the globe, but those things take a while to kick in, and we're not expecting to see the full impact of those monetary policies until early 2024. So what are the big risks now heading into 2023? What do we need to watch out for? What could really unsettle the markets? Top of the list remains inflation. There's just no avoiding it. Inflation is such a massive, massive influencer on how global economies and how markets operate. So people will be watching that data closely, and markets will remain very, very sensitive to inflation data still. Beyond that, of course, any escalation of the war in Ukraine could be catastrophic. China's impact and influence on the war in terms of potentially supplying the Russians or equally doing their own thing in Taiwan also remains a threat as well. And another area of slight concern is the recovery in China. So how quickly are they going to open up? Will there be more lockdowns? How does their relations and diplomacy look with the US? Quite a lot of questions there that are yet to be answered. What we did see over the last 2 years as well was a big government crackdown, particularly on tech firms. So it's going to be interesting to observe whether or not that trend continues or whether they're going to start to loosen up a little bit. One factor that's ticking underneath the surface that may not have such a big impact on the global economic stage, but is definitely a big, big problem, is debt distress in low-income countries. So there are plenty of low-income countries that are in a lot of debt, and with that debt, they've had to spend more money during the pandemic and now face higher borrowing costs, particularly if that debt is being serviced in US dollars. The dollar's strengthened significantly in that time. It's put a lot of countries in a very difficult position. 15% of low-income countries are currently deemed to be in debt distress, and another 45% are deemed to be high risk as classified by the United Nations. Finally, the other big issue that might have an impact on 2023 is basically geopolitics and geopolitical fragmentation. So a continuation of protectionism. We've seen that very much the case in the US with some of the acts that they're passing, such as the CHIPS Act. That means less coordination between the US and Europe. It also means that we're seeing trade barriers popping up between the US and China. There might be retaliation. There could be a sort of continuation, at least, of the trade wars that Trump started and the tariffs that were put in place. And all of these things could really start to unsettle markets. So where is the portfolio at? How is it doing? Here's a very simple graph just in terms of how it's done since the start of the year. You can see here how your money would have reacted if you had popped in $10,000 at the start of the year. You'd currently be up by about $364. But what we've seen is a good increase at the start of January, seemingly some optimism, a reverse of fortunes from what we saw last year and in December particularly, and then a bit of a plateau now in February. The reason for that plateau is multifaceted. It's very, very difficult to pinpoint exactly what is causing that. But I feel like the stock markets at the moment are very, very tentative. They're really on the fence in this balance between whether or not we're going to come into a bullish period following a very, very tough previous year, or equally whether or not things are going to get worse. The economy is going to start to drag down the markets themselves. It's a tightrope between the two. I'm remaining bullish generally for 2023. But I don't think it's going to be smooth sailing at all. I think it's going to be lots of up and down. I don't think it's going to be easy to make money. And I think it's going to be prudent to keep a relatively conservative portfolio rather than completely opening it up and exposing yourself to risky industries. And that's what you can see in the graphs here. So my target asset allocation, ideally, is to have about 50% of all of my investments in individual assets. So equities, cryptocurrencies, whatever that might be. 30% spread amongst a combination of equity ETFs to capture some diversification, and then 10% across both commodities and bonds. That offers quite a wide diversity. It should offer hopefully some consistent growth, but it should also provide the portfolio with a bit of an alpha in terms of excess growth by the individual assets that I select within the technology space. That's where my expertise lie. Because of current climate, current conditions, that asset allocation is not in place at the moment. It's more defensive. And you can see two things mainly in that current asset allocation that are indicative of that defensive approach. One is the short equity ETFs at 3.77%. I've reduced the amount of shorts that we have in the portfolio, but there still remains a little bit. I might increase that, I might decrease it. I'm going to see how the markets play out in the next few weeks. But the other big thing there is cash as well. So cash is relatively risk-free. It's obviously not making money for us, but that cash holding there de-risks the portfolio and also gives me the opportunity to be reactive as well should I spot opportunities. I would like to allocate that cash, hopefully in the coming months, if things appear stable, to some more individual assets, to some technology stocks and assets that I've been watching for a while. But equally as well, I want to open it up and put more into some equity ETFs that I think are going to perform well. As you can see, maybe I've invested in an Indian ETF. I'm going to be looking into emerging markets ETFs as well, and potentially placing some money there, as well as just making sure we catch the upside on more generic ETFs, such as those that track the S&P 500. So this is the overall strategy for the asset allocation in the portfolio. You can see the current asset allocation there, as we saw on the previous graph or the previous slide. But I do try to follow trading principles. So my strategy itself, what I invest in, how I invest might change, but these principles should ideally remain the same within whatever framework it is that I choose to adopt. And that's a risk of around 4 or 5. I don't want to be super low risk because I don't think those returns are necessarily worthwhile. But also I want to keep a cap on risk too, just to make sure that any returns are slightly measured. I operate in low volumes, so I don't trade frequently. I prefer to research companies thoroughly and deeply, and my ideal trading time, just like Warren Buffett, is forever. If possible, I will try and keep and hold investments for as long as is feasibly possible, whilst also maintaining and monitoring and evaluating whether or not those particular investments remain worthwhile. I do add hedges to the portfolio, so hedges operate as counter trades effectively to balance out the portfolio and reduce risk, as well as more diversification, particularly in the recent couple of years, adding diversification to ensure that we're not having all of our eggs in one basket and too exposed in any one area. I largely avoid leverage. I will use leverage if I think there's an appropriate reason to do so, perhaps for hedges, but leverage also incurs more fees on the platform, so avoiding more fees for myself and copiers. In terms of defense, my general principle is just hold, be patient. That usually, well, it almost certainly historically, empirically, and statistically reaps rewards. But where possible, if things do get a bit murky, closing positions, hedging the portfolio and rebalancing the allocation to protect our investments. And that's what's happened in the last couple of years. It's very, very difficult to completely articulate this and graph this and plot this, but things would be a lot worse if I hadn't taken defensive action over the last 18 months or so. I want to finish by talking about artificial intelligence. It's a very hot topic at the moment, AI, and that's largely because of the release of user-facing ChatGPT. It was a product released by a company called OpenAI, and it's caused a bit of a stir, and understandably so. It's, for a lot of people, the first glimpse they've had into the potential of artificial intelligence and AI. And it's a very good product. I mean, it's showing us things that we didn't think were possible from technology, or at least a lot of people didn't think was possible. And all of a sudden, we're starting to get visualizations of the applicability of AI. Now, it's worth recognizing that, of course, this is definitely a step forward, but this is also just the surface level too. There are limitations to ChatGPT. And the first thing that's worth recognizing is that AI is a very broad playing field. What we're seeing with ChatGPT is a language processing model, and that is one application of AI more broadly. AI is going to permeate and be significant across the board in everything we do. It's really going to change society, in my opinion. And in terms of how that's going to affect companies and investment, you can look across any industry possible, from healthcare through to defense, through to standard financial services industries. Artificial intelligence is going to have a very, very strong part to play in those companies within the next 5 years for sure. And then beyond that, it's going to be absolutely core to a lot of operations. So what we're seeing here is, I think, a lot of hype initially, but rightly so. It's kind of turned people onto the idea that AI is coming, that it's real, and that there are applications now. But as we see it intensify and get deeper and broader applications, that's when it's really going to come to life. So what does this mean from an investment perspective? What can we expect? How do we capitalize on this? This is a really, really difficult question to answer, because AI really does epitomize the black box of software. And what I mean by that is, for lots of basic software, you can see the code. It's very transparent. You know how it works. This step follows this step, and you can then make an assessment of the efficacy of that particular software. With AI, a lot of the time it's very black box. It's the opposite, whereby you have inputs and you have outputs, but even the creators in lots of these cases don't even know why certain outputs are being produced. So when it comes to investment and evaluating the products, evaluating who has an edge in this space, it's incredibly challenging to try and make that judgment. One thing that's worth pointing out is there will be breakthrough smaller companies in AI, and OpenAI is a good example of that. It's worth noting that OpenAI is a private company at the moment, but if you do want exposure to OpenAI, I guess kind of indirectly, the investment should be through Microsoft. They invested $1 billion in OpenAI a few years ago, and reports are they're investing another $10 billion, which will ultimately, once some repayments have taken place, result in a 49% stake in the company. So Microsoft are definitely one of the players, but Microsoft are also representative of how this industry, I think, is going to operate, whereby the big investments and the big advancements will come from the big tech companies. There will be anomalies. There will be smaller companies with breakthroughs that create and produce something that captures the imagination and the attention of the public. But any big major breakthroughs, if they're not taking place in the military and with the government, are going to come from these big firms. And I've added a few logos down here. I'm curious to know how many you recognize of that list, but I'll run through those. Microsoft, we mentioned, generally thought to be playing a kind of secondary role at the moment to Alphabet in terms of the depth of the AI stack that they have. So Alphabet has largely been considered to be one of the absolute front runners in AI. And despite bombing their Bard promotional video and scratching $100 billion off their share price because of it, they are still by many seen as one of the preeminent players in this industry. There's other companies that are utilizing AI in different ways. You look at Amazon as one example, in terms of analyzing consumer content, consumer products, fulfillment criteria and their fulfillment operations. And of course, through AWS as well, their huge cloud platform, giving them access to huge amounts of computing power and equally big data too. We're yet to see the full fruition of that with Amazon though. But another company, the one next to Amazon, you might recognize is NVIDIA. And they're in a strong position to capitalize on this, because from a hardware perspective, a lot of their products are being utilized in order to run these big AI engines. Next to NVIDIA there, you'll probably recognize Meta's relatively new logo. Meta, as well as utilizing and, in a lot of people's opinion, wasting a lot of money on the metaverse and investments in the metaverse, have also been in the AI space for a while, quite surprisingly. And again, with 4 billion users across their family of products, you can see quite clearly how, if AI is utilized effectively, there'll be some significant monetization through the likes of Facebook, Instagram, and WhatsApp. For my money, Meta is very much overweight and undervalued at the moment. I think the evaluations and the price drop that we've seen in the last year or so is unjustified. There's a lot of hate towards Meta right now, trying to push the metaverse so strong. But they have such a wide, broad reach across the tech industry that they're not going anywhere. IBM have historically been very much into machine learning and big data. They've been around for a long time and have for a long time been on the cutting edge of innovation. Whether or not they can keep pace with AI, with some of the players we've just mentioned, is a very different question. On the other side of the world, in the bottom left there, you might recognize the logo for Baidu. They are probably in the lead in terms of corporate Chinese AI capabilities. Others like Alibaba are chasing. But I think most investors and analysts seem to sense that Baidu are out front. But again, the monetization of that is a very different question. And there are more specific applicable uses for AI too. So the likes of Salesforce were very active in the M&A space for AI in previous years. They released their product Einstein Analytics, and the AI capability has continued to be built. And you can see, hopefully quite clearly, how AI could be very useful in the CRM space. And the same is applicable to Workday, just next to it there, an HR application, amongst other things. The use of AI there can save companies millions, can make a Workday billions of profit potentially. Between Workday and, as I hope you recognize, the Apple logo there, we have Palantir, which is a defensive company doing lots of big contracts for the US government at the moment. Their innovation, and a lot of it's quite secretive, is in the software space of military products. Once more, black box software is difficult to know exactly how effective their capabilities are, but the US government seems to think they're doing something right. It's not a company I'll be investing in anytime soon. But again, AI has very, very broad and potentially very, very significant uses. Finally, Apple is the big question mark. So Apple are very much keeping their cards close to their chest. It's very, very difficult to understand just how deep their AI capabilities are. They try to embed it in a lot of their hardware in terms of how some of their hardware operates. But no one really knows what Apple's doing. There were rumors and hints that there'd be some AI announcements this week. They haven't materialized. So I think they're waiting until they have a more refined product. And we've seen that with mixed reality and virtual reality headsets that they're hoping to release. They very much wait until they have a refined, usually high-end product that can wow consumers. So we'll see what they have to offer. To summarize though, AI is here. It's been here for a while, but we're starting to see it bubble to the surface more eminently now. Getting on top of it and investing in it, as I said, is very, very challenging. But if you want exposure, you can indirectly get that through the big companies. If you find and identify individual companies and have a good understanding of the depth of the complexity of their AI, then there's lots of money to be made, but it's a very, very difficult ask. I'll obviously be keeping my eye out, looking for opportunities, evaluating and monitoring advances in this space, and I'll be doing my best to make sure that the portfolio capitalizes on those. So that wraps up the presentation. If you do want to get in touch with me, please do connect on eToro. Feel free to send me a message. I'm usually most responsive if you add a comment to my pinned post. If you want to connect outside of the platform, you can also use the details there on the screen for LinkedIn. Add me, send me a message. I'm very happy to discuss strategies, any topics that you like, and answer any questions you may have. Have a wonderful day.